In 2021, Etsy was worth more than many established retail chains. Nearly 100 million people were buying handmade gifts, custom jewelry, and quirky home decor from small sellers who turned their kitchen tables into real businesses. 4 years later, the CEO is gone. The company's biggest acquisition is being sold off at a loss, and the sellers who built the platform are paying 30 to 50% more in fees than they were before the boom. So what happened? How did a marketplace that was supposed to be the anti-Amazon end up alienating the very people who made it special? The answer isn't some dramatic scandal or a single catastrophic decision. It's actually something much more common in recent years. Etsy got a once-in-a-generation gift from the pandemic, and instead of using it to grow the pie, it used it to take a bigger slice. By the end of this story, you'll see how. Etsy was founded in 2005 in Brooklyn, New York. The idea was to build an online marketplace where creative people could sell handmade and vintage goods to buyers who actually cared about that sort of thing. Keep commerce human, they said, and for a long time, that actually meant something. If you wanted a custom engraved cutting board for a wedding gift, or a hand-knitted sweater for your dog, or a vintage lamp that nobody else on your block would have, Etsy was the place. It wasn't trying to compete with Amazon on price or speed. It was competing with their soul. By the time the company went public in April 2015, it had built a genuine community, about 1.6 million active sellers and 24 million active buyers were using the platform. People felt good about shopping there, and sellers felt good about selling there. The problem was that all those good feelings didn't translate into profits. In its first full year as a public company, Etsy generated $2.4 billion in gross merchandise sales and pulled in $273.5 million in revenue, but it posted a net loss of $54 million. Wall Street wasn't impressed. The stock fell sharply after the IPO. Investors weren't sure what to make of a company that talked about reimagining commerce but couldn't figure out how to stop bleeding money. Etsy had the community, the brand, and the cultural cachet, but it didn't have a plan to turn any of that into consistent profits. The CEO at the time, Chad Dickerson, was a true believer in the mission. But true believers don't always make the best operators. Something had to change. In May 2017, Etsy replaced Dickerson and cut 8% of its workforce. The new CEO was Josh Silverman, and where Dickerson had been the idealist, Silverman was the pragmatist who talked about focusing on the fewest things that can make the greatest impact. And it worked. Silverman invested in search so buyers could actually find what they were looking for. He moved the whole platform to the cloud and started spending seriously on marketing, including Etsy's first real television campaigns. Then he pushed sellers to offer free shipping on orders over $35. He tightened up the operation without gutting the thing that made Etsy different. By the end of 2019, the numbers looked completely transformed. Revenue hit $818 million, and the company was actually making money. Gross merchandise sales had climbed to nearly $5 billion, posting just under $96 million in net income. Active buyers had nearly doubled to 46.4 million, and sellers grew to about 2.7 million. Silverman had taken a money-losing marketplace with a nice mission statement and turned it into a real business. Heading into 2020, Etsy had genuine momentum and a clear plan to keep growing at 16 to 20% a year. Then the pandemic hit, and all those careful plans went out the window. When the world locked down in early 2020, e-commerce exploded everywhere. But Etsy caught a wave that was uniquely its own. Millions of people suddenly needed face masks, and Etsy's army of small sellers could make them faster than almost anyone else. Crafters who'd been selling jewelry or stickers pivoted overnight to sewing masks at their kitchen tables. It was exactly the kind of grassroots, human-scale response that Etsy was built for. By the fourth quarter of 2020, mask sales still accounted for about 4% of the Etsy marketplace's overall sales. But the bigger story was everything else. People stuck at home were redecorating their living rooms, picking up new hobbies, and buying gifts online instead of going to stores. Etsy was perfectly positioned for all of it. The numbers were staggering. Full year 2020 gross merchandise sales more than doubled to $10.3 billion. Revenue more than doubled to $1.73 billion. Net income jumped to $349 million, up 264% from the year before. In a single year, Etsy acquired 61 million new and reactivated buyers, and the number of habitual buyers, the loyal ones who kept coming back and spending real money, grew 157%. In September 2020, Etsy got added to the S&P 500. Josh Silverman called 2020 an inflection point in history for e-commerce and for Etsy. He talked about how circumstance met preparedness and how Etsy had gained meaningful market share. And he wasn't wrong about the inflection part. He just might have been wrong about which direction it was pointing long term. The momentum carried into 2021. Gross merchandise sales hit new records, and revenue reached $2.33 billion. Etsy set records on Black Friday and hit 2,000 orders per minute on Cyber Monday. Silverman talked about how Etsy could become the starting point for a buyer's e-commerce journey. That's a bold claim for a company that started as a place to buy handmade soap. Flush with cash and confidence, Etsy went shopping. In June 2021, the company paid $1.63 billion for Depop, a Gen Z-focused fashion resale app where about 90% of users were under 26. Silverman called it the resale home for Gen Z consumers and said there was significant potential to scale it up. They also bought Elo7, a Brazilian handmade goods marketplace. Combined with Reverb, the musical instrument site they'd picked up in 2019, Etsy now had what it called a house of brands. The idea was that each marketplace would operate independently while sharing Etsy's expertise in product, marketing, and technology. It sounded great on an earnings call. Then came the fee hike. In February 2022, Etsy announced it was raising its seller transaction fee from 5% to 6.5%. That's a 30% increase on the fee sellers pay every time they make a sale. The company said it planned to invest most of the extra money in marketing, seller tools, and customer experiences. The sellers didn't buy it. In mid-April 2022, they organized a strike. They wanted the fee increase canceled and the option to opt out of Etsy's offsite ads program, which automatically enrolled all sellers and charged them when a buyer clicked an ad and made a purchase. Etsy's response was to claim that less than 1% of its roughly 7.5 million sellers went into vacation mode, and that the impact on sales was not material. Technically, that's probably true, but it missed the point entirely. The strike didn't hurt Etsy's quarterly numbers, but it was a signal that the relationship between the platform and the people who actually made it work was starting to fray, and the timing couldn't have been worse. The post-pandemic hangover hit Etsy like it hit most of e-commerce, but the company had less cushion than it thought. The buyers who'd flooded in during lockdowns started drifting away, and the ones who stayed weren't spending as much. Gross merchandise sales started declining year over year. Active buyers, which had peaked above 96 million, began shrinking. The house of brands wasn't delivering the growth Etsy had hoped for. By December 2023, the company announced it was cutting about 225 jobs, roughly 11% of its marketplace workforce. The restructuring would cost $25 to $30 million, mostly in severance. Shares fell 7% on the news. The company that had just been celebrating record everything was now laying off workers and watching its stock crater. If you're still watching, you're exactly who this channel is for. We're trying to get to 100,000 subscribers in 2026, and by clicking that subscribe button, you don't just stay in the loop for future videos. You help us to grow and make the best content we can. Thank you. In February 2024, Elliott Investment Management, one of the most well-known activist investors in the world, revealed it had built a double-digit stake in Etsy, making it one of the company's largest investors. Elliott portfolio manager Mark Steinberg got a seat on the board effective February 5th. The stock was trading around $72 at the time, down about 75% from the $294 peak. Steinberg said he joined the board because he believed there is an opportunity for significant value creation. When an activist investor that size shows up and starts talking about value creation, it usually means they think the current leadership isn't getting the job done. Things moved from there. In October 2025, Etsy announced that Josh Silverman was stepping down as CEO after more than 8 years. His replacement was Kruti Patel Goyal, who'd been serving as president and chief growth officer and had run Depop for nearly 3 years. Silverman would stay on as executive chair through the end of 2026. Shares fell nearly 10% on the news. The full year 2025 results told the story of where Etsy had ended up. Consolidated gross merchandise sales were $11.9 billion, down 5.3% from the prior year. Revenue actually ticked up slightly to $2.88 billion. Net income dropped to $163 million, down 46% from $303 million the year before, and the balance sheet showed a total stockholders deficit of negative $1.1 billion. That means the company owes more than it owns. Etsy had $2.33 billion in long-term debt and had spent $777 million buying back its own stock just in 2025. Over the years, the buybacks had been enormous, funded partly by debt. The company was borrowing money to shrink its share count while its core business was also shrinking. The house of brands was being taken apart. Etsy sold Reverb in June 2025. Then, in February 2026, it announced the sale of Depop to eBay for $1.2 billion. That's roughly $430 million in value gone on a single deal. But there's another way to look at the numbers that can paint an even clearer picture. Etsy's revenue in 2019, before the pandemic, was $818 million. By 2025, it was nearly $2.9 billion. That looks like incredible growth. Those are consolidated revenue numbers. So yes, they include the brands Etsy bought during the boom. But when you isolate the main marketplace, the math still tells the same story. The core Etsy marketplace, excluding the house of brands, did about $4.7 billion in gross merchandise sales in 2019. In 2025, the number was $10.46 billion. So the actual stuff being sold on the platform roughly doubled, but revenue more than tripled. How does that work? It works because Etsy kept raising the percentage it takes from every sale. In 2019, the company kept about 16 or 17 cents of every dollar spent on the platform. By 2025, that number had climbed to about 24 cents. That came from higher transaction fees, mandatory advertising charges, and payment processing costs that all landed on sellers. So, when you hear that Etsy's revenue grew, understand what that really means. It doesn't mean more people were buying more stuff, it means Etsy was charging its sellers more for the privilege of being on the platform. The pie didn't grow nearly as fast as Etsy's slice of it, and both sides of the marketplace felt it. Active buyers fell to 86.5 million by the end of 2025, down 3.4% year over year. Active sellers on the Etsy marketplace dropped to 5.6 million, down 1.5%. Fewer sellers meant less unique inventory. Fewer buyers meant less traffic for the sellers who stayed. It's the kind of slow erosion that doesn't make headlines but quietly hollows out a marketplace from the inside. If you want to know about other companies that are hollowing out, read my newsletter. I go over distressed debt, leveraged finance, bankruptcies, and restructuring company research to help you fill in the blanks. Click the link in the description. There were some small bright spots. New CEO Kruti Patel Goyal struck an optimistic tone, saying the company's clear strategic focus and solid execution are driving progress on the journey to bring the Etsy marketplace back to sustained growth. The Etsy marketplace posted slight gross merchandise sales growth of 0.1% in the fourth quarter of 2025, the first positive number in a while. The company is expecting full-year growth in 2026. But slight growth is a long way from the doubling and tripling that defined the pandemic years. Etsy still has 86.5 million active buyers and over $10 billion in marketplace sales. Those aren't small numbers, and the platform isn't going away anytime soon. But the question hanging over the whole thing is whether Etsy can ever get back what made it different in the first place. The company was founded on the idea that buying something from a real person who made it with their hands was worth something extra. For a while, millions of people believed that. The pandemic proved it at an enormous scale, but somewhere along the way, Keep Commerce Human stopped being a mission and started being a tagline. You can't charge your sellers 24 cents on every dollar and claim you're keeping things human. You can't dismiss a seller strike as not material and pretend the community still comes first. You can't buy a company for $1.63 billion, sell it for $1.2 billion, and call that good stewardship. Etsy's story isn't over, but the version of Etsy that captured people's imaginations, the scrappy Brooklyn marketplace where your neighbor could sell handmade candles to someone across the country, that version has been gone for a while now. What's left is a platform trying to figure out how to grow again after spending years extracting more from the people who already showed up. And that's a much harder problem to solve than the one they started with. To watch more videos about companies struggling with serious problems, click on the links above.